Welcome back. In order to boost the economy and the slow growth, the Reserve Bank of India has decided to cut the repo rate to 5.75%. Right now, the RBI governor, Shaktikanta Das, is speaking. He's giving more details on the various measures that is going to be taken by the Reserve Bank of India to give this boost. Let's listen in.
Monetary policy from neutral to accommodative. The unanimous vote reflects the resolve of the MPC to act decisively and act in time. I thank the MPC members for the rich and fruitful discussions which are reflected in the resolution and in the policy decision. I also wish to express my gratitude to our teams in the Reserve Bank of India for their hard work and diligence in providing valuable support and inputs to the MPC for its work. Let me now turn to the key global and domestic developments that the MPC has reviewed. At the outset, the MPC noted that global economic activity has not been able to sustain the improved performance seen in the first quarter of the calendar 2019 in the face of deepening slowdown in trade and manufacturing, which has impacted advanced and emerging market economies alike. Inflation remains below the target in several economies. In advanced economies, incoming data for second quarter of 2019 point to loss of momentum relative to the first quarter. In a major emerging market economies, economic activity has either slowed or has contracted. It is in this context that the central banks across the world have moved to an accommodative stance in setting monetary policy. Financial markets have been unsettled by the acrimonious US-China trade tensions. Crude oil prices remain volatile, reflecting evolving demand-supply conditions and geopolitical concerns. Most emerging market economy currencies have depreciated against the US dollar. On the domestic front, the MPC noted that the May 31st, 2019 data release of the National Statistical Office showed that the GDP growth for 2018-19 has been placed lower by 20 basis points at 6.8% relative to its February 28th estimate. In Q4 18-19, GDP growth decelerated sharply to 5.8%, down from 6.6% in Q3 and 8.1% a year ago. On the supply side, agriculture and allied activities contracted while manufacturing activity weakened sharply. Service sector growth accelerated, although construction activity slowed down markedly. Looking ahead, the Indian Meteorological Department has predicted that the southwest monsoon rainfall, that is June to September 2019, is likely to be normal at 96% of the long period average. The third advance estimates of food grain production at 283.4 million tons for 2018-19 were lower by only 0.6% as compared with the final estimates for the previous year. Further, the stock of food grains at 72.6 million tons as on May 16, 2019 were 3.4 times the prescribed buffer norms and provide a backstop against any supply disruptions due to weather adversities. In the industrial sector, growth in 8 core industries decelerated sharply in April. Credit flows from banks to large industries, however, strengthened, though they remained somewhat muted for micro, small and medium industries. Seasonally adjusted capacity utilization in the manufacturing sector slipped to 75.2% in Q4 from 75.8% in Q3. Import of capital goods, a key indicator of investment activity, remained anemic in April. High-frequency indicators suggest moderation in activity in the service sector. Turning to inflation, the MPC took note of the fact that retail CPI inflation remained unchanged in April from its March level of 2.9%. Higher inflation in food and fuel groups was offset by lower inflation in items excluding food and fuel. Inflation expectations of households in May 2019 round of RBI survey declined by 20 basis points for the 3-month ahead horizon. compared with the previous round, but remained unchanged for the 1 year ahead horizon. Normal growth in rural wages and in the organized sector staff costs remain muted. Liquidity in the system turned to an average daily surplus in early June after remaining in deficit during April and most of May due to restrained government spending. Apart from liquidity injections through LAF operations, the RBI conducted two OMO purchase auctions in the month of May amounting to 25,000 crore and a US dollar buy-sell swap auction of $5 billion equivalent to 34,874 crore for a tenor of 3 years to inject durable liquidity into the system. An OMO purchase auction of rupees 15,000 crore has already been announced to be held on June 13th, and this will be naturally, the auction would be held during next week. Transmission of cumulative reduction of 50 basis points in the policy repo rate in February and April 19 was 21 basis points to the weighted average lending rate, that is WLR, on fresh rupee loans. Interest rates on lower tenor money market instruments remained broadly aligned with the overnight WACR, reflecting near full transmission of the reduction in policy rate. The 10-year government securities benchmark yield has also declined by about 40 basis points from its average in April 2019 to about 7%. This was the position before we announced before the MPC resolution and the decisions were put in the public domain. Thereafter, the developments I have to see. The Reserve Bank will ensure that adequate liquidity is available in the system for all productive purposes. Exports grew by 0.6% in April 2019, but imports grew at a somewhat accelerated pace, leading to a widening of trade deficit. After a sharp recovery in March, net foreign portfolio inflows have been relatively modest at US dollar 2.3 billion in 1920 during the months of April and May. India's foreign exchange reserves were at 421.9 billion. I repeat, 421.9 billion as on 31st May 2019. Taking into account these factors, the impact of the recent policy rate cuts, and assuming normal monsoon in 2019, the MPC revised the path of CPI inflation to 3 to 3.1% for H1 2019-20 and 3.4 to 3.7% for H2 of 1920, with risks broadly balanced, as against 2.4% for Q4 of 18-19, 2.9 to 3% for H1 of 1920, and 3.5 to 3.8% for H2 of 2019-20. Risks around the baseline inflation trajectory emanate from uncertainties relating to monsoon, unseasonal spikes in vegetable prices, international fuel prices and their pass-through to domestic prices, geopolitical tensions and financial market volatility, and the overall fiscal scenario. The headline inflation trajectory remains below the target even after taking into account the expected transmission of the past two policy rate cuts. Hence, there is scope to boost aggregate demand and in particular private investment activity while remaining consistent with the mandate of flexible inflation targeting. The MPC also revised the projection of GDP growth for 1920 to 7% in the range of 6.4 to 6.7% for H1 and 7.2 to 7.5% for H2 of 2019-20, with risks evenly balanced, as against 7.2% in the range of 6.8 to 7.1% for H1 and 7.3 to 7.4% for H2, with risks evenly balanced, which was the earlier projection. The MPC noted that growth impulses have significantly weakened as reflected in a further widening of the output gap. So I have broadly explained the background of the decision of the Monetary Policy Committee to shift the stance to accommodative and also to and also for rate cut of 25 basis points. Let me now set out some of the developmental and regulatory policy measures that we have announced today. In the area of regulation and supervision, banks have been monitored against an indicative Basel III leverage ratio of 4.5% to mitigate risks of excessive leverage. Keeping in mind financial stability and with a view to moving further towards harmonization with Basel III standards, it has been decided that the minimum leverage ratio should be 4% for systemically important banks and 3.5% for other banks. In pursuance of the guidelines for licensing of payment banks and small finance banks of 27th November 2014, it is proposed to issue draft guidelines for on-tap licensing of small finance banks by end of August 2019. More time is, however, needed to review the performance of Payments Bank before considering the license of more Payments Bank to be on tap. It may be recalled that in August 2010, the Reserve Bank introduced a separate framework for regulation of systemically important core investment companies. In the light of the increased complexity of these corporate structures, their growing interconnectedness with the financial system, and the various recent developments, it has been decided to set up a working group to review the regulatory guidelines and supervisory framework applicable to the CICs. Turning to financial markets, it has been decided to constitute an internal working group to review comprehensively the existing liquidity management framework and suggest measures to simplify the current liquidity management framework and clearly communicate the objectives, quantitative measures, and toolkit of liquidity management by the RBI. The group is expected to submit.
Okay, so the big news is this repo cut by 25 basis points. We have with us Managing Editor Business Today, Rajiv Dubey, to just put in more details, to give us more details and perspective. Home loans is to get cheaper. Rajiv, just tell me something. Is this one of the important steps taken by the governor to infuse life into the economy? Because one of the things that we were just talking about was about slow growth and low consumption, and the quickest way really to boost economic growth is to get people to spend more. How can the Reserve Bank of India ensure that? How can the government in fact ensure the same?
Yeah, so Avantika, the big problem that has happened in the past 3 quarters, which is why the economy is in this state, is because consumption had tanked, and consumption has tanked largely because of sentiment, because of the fact that the rates are very high for people to borrow money, as well as private investment has also been affected in the past 5-6 years. It's actually at a 14-year low. So whatever the RBI governor has said today and whatever the MPC has said today, they all point to the fact that the government is very aware of the fact that it needs to do something very dramatically right now to ensure that there is enough sentiment in the economy as well as enough confidence in the economy for people to start spending more. Now the interest repo rate cut is in a good direction, but unless it leads to banks transferring this repo rate cut to the individuals and industry, it is not going to have an effect, and so far it has not happened. So far, the repo rate has been cut 2.25%, and the banks have only transferred, the largest bank has only transferred 0.6%. So there's a lot that needs to be transferred to the consumer and to the industry. Okay, we'll have to watch this space very closely. But for now, thanks so much for joining us, Rajiv.
Thanks for watching the video. For more such news and updates, please like, share and subscribe to India Today. Also check out our other great videos from our channel. We know you would love to.